Hello everyone, welcome to the course of International Financial Management. In our last lecture, we took a deep dive into economic exposure, what it is, how it works, and how it can affect even companies that appear to have no direct foreign currency dealings. We worked through the examples and the detailed case study of Indus Grand Hotels, where we saw how a mid-size hotel chain with zero foreign currency receivables could see its profit half or nearly double purely on account of exchange rate movements. This was an important conceptual foundation. Today we take the next natural step. Having understood what economic exposure is and how it affects firms' value, we now ask the more practical question: what can companies do about it? How can a firm protect itself from the unpredictable swings of exchange rates that affects its competitive positions, its revenues, its cost, and ultimately its long-term value? Before we study each strategy individually, let us understand what operating strategies actually mean in this context, because this slide gives us the definition and the core logic. Operating strategies are long-term structural adjustments made to a firm's core business activities. Now notice this word structural. We are not talking about buying a forward contract or entering a derivative agreement. We are talking about changing how firms operates, where it manufactures, whom it buys from, whom it sells to. These decisions reshape the business model itself. Now let's talk about natural currency hedge through currency alignment strategy. First, align your cost with your revenue in the same currency so that when the exchange rate moves, both sides of your profit and loss are affected simultaneously and the net impact is reduced. Second, spread your exposure across multiple currencies and geographies so that no single exchange rate movement can devastate the entire business. Third, the great advantage of this approach is that the hedge is embedded within the firm's own operations. It works automatically, continuously, without the cost or complexity of financial instruments. There are many other strategies that we will study in detail. Let me briefly introduce each one. Strategy 2. It talks about diversifying production locations. The idea here is to manufacture in multiple countries so that your cost base can be shifted depending on where the exchange rate environment is most favorable. If your home currency strengthens and your export becomes expensive in foreign currency terms, you shift production to a country whose currency aligns with your revenue markets. Strategy 3. Flexible sourcing strategy. This is a supply side equivalent of production diversification. Instead of committing to a single supplier in a single country, you maintain active, qualified relationship with suppliers across multiple currencies and multiple countries. When one supplier's currency appreciates and make their products more expensive, you simply shift procurement to a supplier in a currency zone that has remained stable or the currency has weakened. Now strategy 4, that is market diversification. In this, you sell in multiple geographies with different currencies. This creates what we call a natural portfolio of currency exposure. Just as diversifying an investment portfolio reduces concentration risk, selling to a customers in USA, Europe, Japan, and Middle East means that no single currency movement can devastate your total revenues. Losses in one market are offset partially, not perfectly, by stability or gains in another. Now let's talk about strategy 5, which is product differentiation. This is one of the perhaps most intellectually interesting. When a firm builds unique products or powerful brands, it acquires pricing power. It means customers absorb exchange rate driven price increase rather than switching to cheaper alternatives. These strategies are not mutually exclusive. The most resilient multinational firms deploy all five simultaneously, and they do so not as a one time hedge but as a permanent, built in feature of their business's architecture. Let us now study each one in detail, beginning with production diversification. Multinational corporations can manage currency risk by choosing where to manufacture. Let's take an example of Toyota Motor Corporation. Toyota Motor Corporation is one of the world's largest automobile manufacturers, producing over 10 million vehicles annually. Toyota has manufacturing plants in Japan, United States, United Kingdom, Canada, China, Australia, South Africa, Thailand, India, and over a dozen other countries. Here how it works in practice. Imagine the Japanese yen appreciates sharply against the US dollar. Suddenly, Toyota's manufactured vehicles in Japan become significantly more expensive when priced in dollar terms. Toyota competitiveness in American market is now under pressure. What does Toyota do? It shifts production to its US plants. Now the cost base is in US dollar. And because Toyota is also earning in US dollar in the American market, the two sides are aligned. The exchange rate movement largely cancels out. Margins are protected. Now flip the scenario. The yen depreciates. Japan made Toyota vehicles become cheaper in dollar terms. Toyota has a cost advantage if it produces at home. So it can shift production back to the Japanese plants, benefit from the lower cost base, and capture higher margins on every vehicle sold abroad. It gives Toyota and the companies that follow this model three critical advantages. First, it reduces dependence on any single cost currency. No one exchange rate movement can structurally damage the business. Second, it creates operational flexibility. Management can actively respond to currency movements by rebalancing where production happens, turning foreign exchange volatility from a threat into a lever. And third, it aligns cost with revenue geographically. When you earn in a currency, you want to spend in that currency too. Manufacturing diversifications makes that possible at that scale. Next strategy that we are going to discuss is the flexible sourcing. And it is a very simple idea. Instead of depending on a single supplier in a single country, a firm maintains active, qualified relationships with suppliers across multiple countries and multiple currency zones. When one supplier's currency appreciates and makes their products more expensive, the firm simply shifts procurement to the supplier whose currency has remained stable or has weakened. The hedge is not a financial contract, it is built into the supply chain architecture itself. Look at the three supplier zones on this side: Taiwan, Vietnam, and South Korea. Each operates in a different currency. When a Taiwanese dollar appreciates, Taiwanese screen become expensive and the firm reduces procurement from Taiwan and increases from Vietnam, where the currency is stable. When the Korean won weakens, Korean components become the most cost competitive options. The firm can increase its procurement from South Korea or can even upgrade its product line using the favorable pricing. The key word throughout is optionality. The firm is not locked into any one supplier. It can source from whichever country offers the most favorable currency position at any given time. But then, multiple sourcing has its own limitation. There is a trade off. Maintaining multiple suppliers relationship cost more than relying on one. Their expenses related to quality audits, safety stock requirements, and ongoing management increases. But this cost is the price of flexibility. And when currencies move, that flexibility can deliver savings far greater than its cost. The one non negotiable requirement is what is called supplier qualification, building and testing these relationships during calm market conditions. So, when currencies move, the firm is ready to switch immediately. Now, let's talk about the fourth strategy, which is called diversifying export. Just as we diversify an investment portfolio across multiple asset classes to reduce the risk that any single asset's decline destroys the portfolio value, a firm can diversify its export markets across multiple currency zones to reduce the risk that any single exchange rate movement destroys its revenue. This is a very simple idea, but its implications are profound. Consider an Indian pharmaceutical company. Let us call it Indopharm Limited, that historically exported 90% of its revenues to United States, with the remaining 10% to domestic Indian consumer. If the INR strengthens significantly against the USD, a common occurrence when India receives large foreign capital inflows. Indopharma's dollar denominated export revenues, when converted back to rupees, become lesser in value, and hence what happens? The revenue falls. Profitability is compressed, and there is nothing to offset this because the entire export book is in one currency. Now imagine Indopharm has deliberately built revenue streams across four markets. Let's say 40% in USA, 30% in European Union, 20% in Japan, and 10% in Middle East. Now AED is always pegged to USD. When INR strengthens against USD, the 40% US revenue is hurt. But Euro and Japanese yen may not have moved identically. The euro might be weakening against the rupee at a different rate or strengthening. The Japanese yen might be strengthening, which actually helps the Japanese revenue stream in rupee terms. The portfolio effect means the movements partially cancel out. This is not a perfect hedge. Currency correlations means that sometimes all currencies move in the same direction against the rupee simultaneously, particularly during global risk off episodes. But over time and across cycles, geographic revenue diversification reduces earnings volatility from exchange rate movements. The additional benefit is strategic. A company with revenue across multiple geographies has a more stable customer base, is less vulnerable to regulatory changes in any one country, and has a stronger negotiating position with the buyers. Market diversification serves multiple strategic objectives simultaneously, and exchange rate resilience is one of the most important things. Now, let us talk about strategy 5. This is the most intellectually subtle of the 5, and in many ways the most powerful over the long run. The core idea is this: when a firm builds genuinely unique products or strong brands, it acquires pricing power. That means it can create flexibility to price its product. The pricing power is, in the language of economic exposure, exchange rate resilience. Imagine two very different businesses side by side. The one on the left sells a commodity like wheat, steel, or crude oil. When its home currency strengthens, its goods automatically become more expensive for foreign buyers. And here the problem, those buyers don't care. They'll simply switch to an identical product from another country that now is cheaper. So the firm is stuck with the ugly choice. Either it has to reduce profit to stay competitive or reduce its sales volume. Either way, it absorbs the full impact of the exchange rate move. Full exposure, highly volatile profits. Now look at the price maker on the right hand side, where they are offering differentiated product. Now Rolex is the example given here, and it is exactly the right one. When the home currency appreciates and the foreign currency price of the Rolex rises, the loyal customers does not walk away. The product is unique, the brand is irreplaceable, there is no equivalent alternative at a lower price. So the customer absorbs the higher cost and the firm's volume holds. The exchange rate move passes to the customer, not to the firm's sale. Because here the customer base is people who are rich. Now they can take the losses much more easily. Now the deeper insight is this: investing in research and development, in branding, in quality, in customer loyalty. These are not just commercial decisions. They are simultaneously decisions that reduce a firm's sensitivity to exchange rate movements. The more unique and differentiated the product, the less power any exchange rate shift has over the firm's volumes and revenues. The contrast between the two columns on this side captures the entire logic of strategy 5 in a single frame. Build the product, that means build the resilience. The two go hand in hand. Now let us revisit Indus Grand Hotels, the mid-size Indian luxury hotel chains we studied in lecture 31. You can recall that Indus Grand earns all its revenues in INR, that is Indian rupee. It has no foreign currency receivables, and yet we showed that an adverse currency movement, that is the rupee strengthening against the euro and the British pound, while simultaneously weakening against the USD. Now, this could cause profits to collapse by over 50%, from 97.6 crore rupees to 48.4 crore rupees. This was a classic double squeeze. Revenue hurt because India became expensive in European eyes, and cost hurt because dollar denominated debt and management fees became more expensive in rupee terms. Now let us apply the strategies we have just studied and ask, what could Indus Grand's management realistically do to reduce this vulnerability? Let us walk through each of these operating strategies for Indus Grand. First, revenue diversification. The hotel currently depends heavily on European and British tourists. A strategic sale to domestic Indian high net individual travelers who pay in rupees would immediately reduce the dependency on euro and British pound revenue, and hence will reduce the euro and British pound exposure. If even 30-40% of rooms are occupied by domestic guests, then a rupee appreciation against the euro has no impact on that portion of revenue at all. The domestic Indian luxury travel market has been growing rapidly, and Indus Grand is well placed to capture this demand. Second, geographic market diversification. Now let's talk about the Gulf Cooperation Council countries, which are UAE, Saudi Arabia, Kuwait. They represent a large and growing travel market. These currencies are largely pegged to the USD, making them a more stable revenue source for Indian hotels. Building marketing partnerships with Gulf based tour operators would meaningfully dilute the Euro British pound concentration in Indus Grand's customer base. Third, and perhaps the most interesting, is product differentiation through unique India specific experience. For example, yoga and wellness tourism, Ayurvedic retreats, heritage palace stays, cultural immersion programs. These are genuinely India specific offering that competing destinations like Turkey or Maldives cannot simply replicate. A British traveller booking a heritage experience in a converted Rajput palace is not comparing this against a beach resort in Phuket. The products are different, the comparison set is eliminated. This is the essence of pricing power. And in the language of economic exposure, pricing power is exchange rate resilience. The more unique and differentiated your products, the less sensitive your volumes are to exchange rate driven price changes. So, operating strategy alone can meaningfully reduce Indus Grand's vulnerability. But operating strategies must be complemented by financial strategies, especially for the cost side of the exposure. Now, let us consider the financial strategies available to Indus Grand hotels. The most impactful financial strategy is currency matching on the debt side, refinancing the USD external commercial borrowing loan into an Indian rupee denominated facility. Yes, the rupee interest rate of 10% is higher than the dollar rate of 6%. But this is not purely a cost comparison. The USD loan creates exchange rate risk. Every time the rupee weakens against the dollar, the INR equivalent of the loan's interest and principal payments increases. This is an uncontrolled, unpredictable cost. By switching to Indian rupee debt, the hotel pays a known fixed rupee denominated cost, which aligns perfectly with its revenue. The 4 percentage point difference in interest rate is the cost of the hedge. Depending on the firm's risk tolerance and financial position, this may be a very rational trade off. Next is the management fees. It presents a different situation. The fund 1.5 million USD annual management fees is a known fixed amount payable quarterly. This is a classic transaction exposure, a specific contractually defined future outflow in foreign currency. This can be hedged precisely with quarterly USD forward contracts at a known exchange rate, eliminating uncertainty on this specific cost line. On the revenue side, the hotel should negotiate with European tour operators to receive a portion of advance booking and deposit directly in euros. If 10 to 15% of the revenue were received in euros, this would create a partial natural hedge. Euro revenues that weaken when the Indian rupee euro rate moves unfavorably would be offset by lower euro denominated cost elsewhere. And finally, as a preview of what is coming in the next lecture, A currency swap should convert the hotel's USD debt service into a euro payment stream, creating a much better alignment between the liability currency and the key tourist revenue currency. Unlike transaction exposure, where a forward contract can, in theory, provide a precise, complete hedge for a known cash flow, economic exposure hedges are inherently imperfect. The regression coefficient B that we calculated in the previous lecture was the measure of economic exposure. It is an estimate derived from historical data. It has a standard error and a confidence interval. You might estimate that a 10% rupee appreciation reduces Indus Grand's revenue by 15%, but the actual outcome can be different. It could be a 10% reduction or a 22% reduction, depending on the competitive dynamics that were not present in the historical period used for the regression. Economic exposure measurement is inherently probabilistic and subject to model error. Now, building a new manufacturing facility in the foreign country, qualifying a new supplier and integrating them into the supply chain, or building a meaningful presence in a new export market, all of these take years of investment. The operational strategies that most powerfully manage economic exposure are precisely those that take the longest to implement. By the time a currency shock is already underway, it becomes very late to react. A firm can't restructure its operation fast enough to outrun the impact. These strategies must be implemented during calm market conditions before the exposure materializes. It is a proactive hedge against future uncertainty. Maintaining flexible sourcing, geographic production diversity, and multi market sales presence is expensive. Duplicate facilities, supplier management overhead, export compliance cost, multiple marketing operations, these all add up. The cost must be weighed rationally against the exchange rate being mitigated. For some firms, particularly small and mid sized companies with limited financial resources, the cost of full operational flexibility may exceed the expected benefit of reduced exchange rate exposure. In these cases, financial instruments may provide a more cost effective partial solution for the near term, while operational flexibility is built gradually. Economic exposure cannot be measured with the same precision as the transaction exposure. Two equally competent analysts examining the same firm might produce different coefficient, that is B estimate, depending on their choice of time, the exchange rates they regress against, and the proxy they use for time firm value. This measurement uncertainty makes it difficult to determine exactly how much hedging is optimal. If your competitors choose not to hedge economic exposure and accept the exchange rate volatility in exchange of lowering operating cost, they may appear cost competitive in short run as there is no hedging cost. A competitor that does not invest in building a multi country supplier relationship might be saving a huge money in supplier management cost. Now, if the currencies were never adverse or never favorable for the competitor, then the competitor was right. Hedging involves accepting a certain cost in exchange of uncertain protection, and competitive market punish firms that pay costs that their unhedged competitors do not. Now let's conclude this lecture. In this lecture, we learned in depth about how to manage economic exposure. We discussed in detail about operational strategies and some of its practical examples. We also examined through the Indus Hotel case on how to apply various financial strategies in the real world scenario. We examined the limitation of economic exposure management honestly, imperfect hedges, time lags in operation adjustments, and the cost of flexibility, measurement uncertainty, and competitive response asymmetry. These limitations do not negate the value of economic exposure management or does not reduce the value of economic exposure management. They define the parameters within its operations. The goal is resilience, not immunity. Now that's all for today. See you in the next lecture. Thank you.